Hey, it's that time of the year. It's holiday season. So for all of our listeners and our viewers, from being myself, we just wanted to wish you guys a happy holidays. Hopefully, we can give you some holiday cheer along with some good wisdom to rebel against and think about over the holiday season.
Yo, B, let's go.
You may have seen the clip and maybe heard word of mouth, yet another podcast. Man, what could it be about? Is it truth or opinion? A couple of contradictions. We're here to challenge tradition and twist your vision. So we set on a mission to bring you rebel wisdom.
Welcome back, Rebels, to another episode of Rebel Wisdom. I'm Julian, here with my co-host B. And as we do, we're going to dive into a new topic today. We're going to talk a little bit about stocks, actually probably a lot of bit about stocks, which is funny because stocks is pretty prevalent in both of our lives. We've woven it into other episode topics, but we're due to give it its own episode. So that's exactly what we're going to do. This will be our stocks episode. But I'm going to go out on a branch and I'm just going to say it. Stocks are not risky, and it's also not a gambling platform, right? I think it's often looked at as like, hey, you can't make money in the stock market. It's way too risky, or people almost just treat it like a game where they're just trying to jump into it and kind of like gamble in a sense, and it's not true. And we're going to talk about why. So, B, I was saying we just introduce maybe stocks a little bit in our lives, maybe how it was brought to us, how we got into stocks, and maybe want to, if you're comfortable, I'll probably share about some of the stocks that I'm in personally, maybe what platforms you use, anything you're comfortable with. But if we could just share with our audience, go for it.
Yeah, like my background with stocks. I mean, dude, it's so I don't mind sharing it, but it's very stocks is so personal to me. It's kind of
And
weird,
yeah, I
but
don't think it's weird.
because I often talk about I read Rich Dad Poor Dad when I was 22, and
Mhm.
that literally changed everything. And I think it's so interesting that book. You have 10 people that read it, and 10 different takeaways for that particular individual. And at least for me, I don't know why, but it led me to stocks. And I was stationed active duty in Japan at the time, so real estate really didn't make sense for me at that point. So, stocks was just the pretty much obvious go-to. And I started buying stocks, and it's the very simple, like buying big name brands. Like I think the first stock I bought was like Amazon. I remember putting in like there's Amazon has done stock splits since, but then the price of Amazon was, I think I bought like two shares for like $3,000 or something, like maybe like 1,500 each or something like that, right? And then literally like a month later, I sold it for like a $500 gain. Which, I mean, in hindsight, right, that's not exactly what you're supposed to do. And from that point, I was kind of like hooked. I was like, okay, I understand. So I thought, obviously. And I started investing in it very heavily. And it's very personal because I'm like, hey, I told my parents, like, hey, I'm like really like interested in stocks things. I'm buying a lot of it. And then my mom was just so worried because my biological father. This is a story that I heard from my mom. So I
Okay.
don't know if whether how true this is, but this is a story I've heard. My biological father's father, so my grandpa on my biological father's side, something during the dot-com bubble.
Mm-hmm.
He was a wealthy guy apparently, and he lost everything,
Mm-hmm.
and then he ended up committing suicide. And then, so that was the extent of the experience that my mom had. And this, she was a single mother for a little bit, remarried to who I call my dad today. And then she hasn't really worked since. She was just, raising me and all my siblings. So when I told her that, she was like super duper worried. I'm like, please, like, that's so risky. Like, you're going to lose all your money. And that was kind of in my introduction to how I understood how other people perceived the stock market.
Right.
And from that point on, I mean, like, I was just you're a 22-year-old kid, right? Like, no one's going to convince you otherwise. So I started buying stocks. And then I think I learned from good mentors, mostly from books. So the mentors would be the authors that I read about. And yeah, I mean, like, I don't mind sharing the numbers because obviously it's a success story. Somewhere along the way, I was like, you know what, I really want to switch to real estate. But then I was like, as long as I'm in Japan, I'm gonna keep buying stocks. And at some point, when I was like 27, I did peak out at like 300K, not in profit, but like the overall account value. I mean, in hindsight, looking at it, that was a very, very, very lucky. I made very risky moves. We were in the greatest bull market that I've ever seen in my investing life, with like, you know, investing career of like 5 years. And then I cashed everything out and then transitioned to real estate. And now I'm getting back into stocks now, and I'll give you every single stock that I own today in my portfolio, which is SPY. I own one stock, and that's about it.
That was a very thorough introduction to your, and kind of intimate introduction to your, I guess, investing history, or in stocks at least, your stock investing history. So dude, that's awesome.
Mhm.
And I think this is perfect for us because it's gonna be like a full circle moment. I think my I want to say introduction, like, right. So I knew what stocks were, heard about it, but wasn't interested in it, wasn't trying to learn about it, wasn't talking about it really. I would say my most significant introduction to stocks, like, kind of came from you. Like, we were stationed together, as you mentioned, in Japan, and like you like developed this interest in it. I think from reading Rich Dad Poor Dad, and then you like randomly you were like, bro, you got to read this book. Also like here's stocks I'm looking into. Like I really think you should get into it. And I was kind of like, no. I think I was more uh you were much more comfortable with like taking risks than me at the time. And so I was like, dude, I hear you. It's like sounds interesting, but I was like, I gotta like slow roll it. So I eventually read Rich Dad Poor Dad, but I don't think that book has as strong as a correlation to me getting into stocks as it did for you. But nonetheless, I read the book. I got into stocks months after you did, um, and been in the market ever since. It's, and it has been an interesting journey, and I'm sure this will get woven into our conversation as well. But I'm a big, believer in like index funds and ETFs, exchange traded funds. But I also, like, unlike yourself, currently, I still have some holdings in just my individual companies, which I'm gonna pull up my Robinhood account now, which is one platform I use. I'm literally just gonna go down the line, and all of the, not all of these, 80% of these. I mean, I don't hold in too many companies, but I got like way back then, like when we were in Japan, which was like 2017, like 2020. And I just bought and held. I may have increased my position a couple times, but like these are things like I bought and like literally never sold. And then I bought some of these since, but I'll just get on the line for me. And I think it's cool that like by me reading this listing that I'm about to read kind of gives you insight on who I am, because like I believe you should kind of buy, or you should hold in companies that influence your life or that you buy in. So it's like, when you buy these things, I'm a huge Nike fan. Syndicated there. B's repping the check right now. But like one of my stocks is Nike. Well, I buy a ton of Nike. So in my head, why would I not get some profit off of Nike, which they've been doing terrible? But that was my entering logic, at the time. So for me, I have Apple, Microsoft, Disney, Nike, Amazon, Netflix, and Nvidia. And that's on that platform. And then on another platform I have, this one's a little bit more, I have some like ETFs in this one. I have VU, which is I think Vanguard's like S&P 500 pretty much stock. And then I have Meta, Tesla, and NASDAQ. Um, no really reason why they're on this platform, is just kind of how it fell out on the time. None of these are new. I started these like years ago, and that pretty much makes up like all of my holdings. So again, and that, I've been fortunate too. I got in at a good time, and most of those companies, I'm sure you've all heard of. They're big name companies. It's nothing, no like small individual like startups or anything. And they also represent my life. So that's kind of my journey through stocks. It's funny, just like maybe a year ago, I was also like talking to my parents about stocks, and my mom was like, she's heard my position on it and maybe some of my small successes in the stock market. She was like, no, I think I would try it. And she literally just threw in like $100. But it was fun to kind of like talk to my mom about it, whose opinion on the stock market has traditionally been what we mentioned in the beginning, that, it's kind of risky and I don't think I can make a lot of money. And I got her into like maybe 2 different companies, and she made a couple bucks. She threw in $100, but it was cool for her to see just the potential of what the stock market could do. Uh, and that's my introduction to stocks. So
Yeah.
I guess I owe you
Oh, I do want
the
to point out, you said when you were talking about it, you said that I bought at a good time, right? And I think that's a very interesting statement.
oh yeah, we get
And
into it.
I think you bought at a good time because that good time in quotation was in the
Mhm.
past. And I think
Nope.
that's what that means. Like buying at a good time just means like in the past. And today, if you're thinking about it, a lot of people are like, "Oh, stock markets are." We're recording this November 16th, so stock market isn't at the. It didn't close Friday at an all-time high, but like pretty much it's near all-time high levels.
Mhm.
And a lot of people are like, "Dude, like don't invest because it's at the top." Like blah blah blah
Right.
blah. Well, the fact that the S&P 500, the stock market is at all-time highs, that means that it'll keep
It's
for
trending up.
for the past the history of the United States,
Yeah.
the history of the S&P 500, like it has overcame, it keeps hitting all-time highs over and over and over again. And there's a there's an interesting study that I hear a lot about in the, stock market investing platforms and channels, but there's 5 investors in this particular example.
Mhm.
And you have investor A that literally he every single year he puts in $2,000, right? But he has the magic crystal ball and he knows the lowest point in that particular calendar year of stocks. And on
Mm.
that day, he puts in the $2,000. So he's like the perfect investor, right?
Yeah.
You have
Before you
investor
continue,
B, which in
real quick, I want to say a typical thing you hear in buying stocks, especially if you're like entry level, is like buy low, sell high, right? That's like a old adage or whatever. So it's interesting. I think that person A, and I haven't heard what he's about to say about either. But I think that's probably gonna find itself to be kind of funny that buy low, sell high isn't like bad, but there's probably better methods, especially if you're operating long term, that almost may make that irrelevant. So I just want to highlight that point before you continue because I feel like that's gonna be relevant in what you're about to say. But sorry, continue.
yeah, because you can't you don't I mean this person
You don't
A
know.
invested at the perfect buy low or buy low and then
Mm-hmm.
but you don't know yeah, you
Mm-hmm.
don't know the time. So it
Exactly.
doesn't it doesn't really make sense. You can't mimic this person. Person B each year everyone has the $2,000 each year and the she or they said she I don't know, it was investor B puts in $2,000 at January 1st or the first trading day of the year. Person C, so he divides $2,000 by 12 and he puts that in at the beginning of the month, each month. So overall, it adds up to $2,000 on December 1st. And person D, she invests $2,000 at the peak of each calendar year of the market. So literally the opposite of the best investor.
Mm-hmm.
And person A, B, C, D, E,
E.
E, right? Yeah. Person E uh, puts the $2,000 into pretty much cash. So they said cash treasury. So like it's returning very low numbers, right? And it's very interesting because over the 20-year period this like hypothetical study was done, the market has risen 75.4%, and that was
Mhm.
from 2003 to 2022 when this study counts. Person A obviously did the best, right? Like he was able to time the market perfectly each calendar year, and he ends up with $173,000.
Mm-hmm.
But the very interesting thing is, person B that just put the like they just put the money the first trading day of the year,
Mm-hmm.
$2,000 in January, like third or fourth or something like that. And person or investor B had $161,000. So you're talking a delta of 12K over 20 years, which is not a lot,
Yep.
right? So that just kind of already speaks to you don't need to be this like crazy. You don't need to time this market or stock market crazy to make money in it. And investor C, they put money at the beginning of each month. They divided 2,000 by 12, and then that amount you put each month. And then they came in a little bit lower, and it was at 141,000. So you're talking delta from from investor A of like $30,000, which obviously you want those $30,000. Who doesn't? But that's still not bad. Like there was no thought. Into, hey, when should I buy? When should I sell? That kind of thing. And you have person D that literally like invested at the most terrible time in history of that calendar year, and she ended up having $63,851. So basically, like, you cannot get worse than investor D. Impossible, right? And you have investor C, I mean, investors in quotations again, but she pretty much just held cash. And that cash amounts to $24,000, right? So the point of the story is, one, it's very easy to mimic these like really good investors because you just kind of buy in without thinking on a set date of a particular calendar year. And lesson two is, you can be the worst investor of all time, but as long as you're buying good index funds like S&P 500, for example, it's better than holding cash. So I think that speaks volume to me, at least. And it should be it should be like a research study indicator that everyone should be investing stock somehow.
Man, I have two things to say about what you just said. One, I mean, they said invest in the stock market. I'd be interested. Was that study or that example based on like, was that S&P 500? Did they say what they invested in?
Yeah, that's all S&P 500. Yeah.
Okay.
S&P 500.
Okay. Which is, for those listening, what Standard & Poor's 500? Is it top 500 performing companies, or what's the 500?
Yeah, so S&P 500 is it's the top 500 companies, and they traded in the U.S. stock market, but there's a little bit of caveats.
Yeah.
The best 500, they have to be profitable for the last 4 quarters. So for the last year, they have to be profitable.
Yeah, profitability. Okay, that was the last detail I was looking for. Thank you. And my second thing I was going to say is, bro, we can end the podcast after that. That literally just broke down in various ways, like why the stock market, again, is not, doesn't really affect why it's not a gambling platform, but certainly why it could be beneficial. I won't even say if used correctly. I mean, yeah, there's a element of knowing what you're doing. But like you said, there's methods where you can put almost little to no thought into it, and you will be profitable. It's just by what extent will you be profitable. So yeah, I will say to attack investor A in your example, or address rather, not attack. You're right. It's an unrealistic example, which is why it's the best, because he had future knowledge, which obviously none of us will ever have. Even if you're the most like inside trader, like you can't have absolute future knowledge, but you can have historical knowledge, which I think gets at partially why I, again, in quotes, invested at a good time. Some of it I think was dumb luck, but some of it was like looking at historically, where the market might have been, and also maybe catching it right before it was a bull market, just meaning before the market in whole was like very profitable. So yeah, some of it's luck, some of it's timing, but I think ultimately, to your point, B, the best time to get in is like now or yesterday, right? The earlier you can get in the stock market, the better. And there will be, everybody's individual journey is different. Like you and I, right? We got in, I mean, relatively in the span of our stock market investing careers, very similar. We're probably within a year of each other, but you got in far before I did. But yeah, like the best thing is now. And I think both of us are all like, dang, I wish we would have started earlier. And sure, it's all dependent on how much expendable capital you have. Like,
Yeah.
but even with that being said, like you can always put in a little something. And something in looking into this podcast that I recently, I just never heard. I heard of the idea, but like this is, time in the market is better than time in the market. I think that's just a cool way to look at it. about, yeah, you can look at all the analytics, the data, the historical trends, try to time the market. And if you're savvy with that, like, power to you. But really, it's the time in the market. And the only way to maximize your time in the market, again, is to get it now, which you kind of talked about. So, dude, that was a phenomenal breakdown synopsis, I think, leading us into this conversation. But it looked like you were about to say something. Did you have something?
Yeah, like I think it's almost like even to preserve your wealth, right? We were looking at investor E that just held cash. Like, yeah, $2,000 a year for 20 years is $24,000. But looking at the purchasing power, that person lost money, right? Because you have
Great
inflation
point.
that you have
Yes.
to account for.
Account for.
And I think it's almost like a mandatory thing to at least investing something because there's no one is I think everyone in the United States, Democrats, Republican, Independent, we can all agree political wise, like US, the government is not going to be spending their money the best. And we're going to keep printing more money by the Fed. Everyone kind of agrees on that point. So as people, as the Fed prints trillions and trillions and trillions of dollars over, X years period, your dollar that you hold is going to go down in value every single day. So if you put the dollar that you get, you have to convert it into the stock of, a company for this example. At least that company is going to benefit for all the money printing because they're going to see it in forms of, growing their revenue, growing their profits, which in return is going to, pump up their stock price. And I mean, it's like you have to you're gonna get destroyed if you don't invest. That's like the point I'm trying to get at. And even if 2025 we hit all time highs like every single day, let's just say in 2050 we're gonna say, oh my god, like you bought stock in 2025, like you were so lucky. Like no, bro, you're
No.
lucky. We just made a reasonable decision to buy stock because it's gonna go up in a long term. And there is a really, 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 really big caveat of you have to buy good stocks. And I don't, you can kind of guess which ones are the good stocks, but I don't know for sure. That's why I just stick to index funds. It's just so easy. I don't have to think about it ever. Like when I was investing in, individual companies before I got into real estate, I like I said, I definitely got lucky. Dude, I was like buying stocks just randomly with no research because I just there was like, oh, this company does this. I'll just read like the headline of what they do. I'm like, oh yeah, I can see them making money in it, and I'll buy like $5,000 of stock when I'm like super drunk, for example. And it somehow ended up working out, but like in hindsight, that was an awful, awful, awful decision to make. And yeah, I mean, I'll probably never do that again. So that's like, you know, I advocate for the S&P 500 or, it doesn't have to be S&P 500, but good index funds that kind of covers so many different stocks that, in the long term, it's going to go up.
Right. Yeah, it's good, dude. And right, index funds basically just track specific groups of like assets, we would say. So right, so you're not putting all your money into one specific company or area, which is why I think you and I kind of advocate for it. It's a way to minimize your risk, right? So going back to the stock market is inherently risky. I mean, I can't say debatable. There's always risk. There's always risk. But you can greatly, as an investor, kind to minimize or hedge your risk based on what you invest in. Right? Like to your point of saying like it's almost mandatory to invest. I think it is I also think it is financially wise to invest, right? And we're on this episode, we're specifically talking about stocks. There are other things to invest in, but I like stocks because of the element of diversification. And by it being so diverse, now it allows you to reduce your risk investing in these index funds and some of these ETFs that we're talking about and alluding to. That's what I think is the power behind the stock market. You can get in at any time. It's best if you get in now and if you hold long term. But everybody has different investing strategies or reasons to invest, right? You might have a time horizon on like, hey, I'm trying to make money by, a 5-year point. Sure. And
Mhm.
maybe there's other ways to invest for whatever your specific time horizon is. But yeah, I have to, I feel like we'd be doing a disservice if we didn't attack the idea of like, dude, this stock market's so risky and you can't make money. False. That is a false statement. So yeah, it's fun to kind of talk about
Yeah.
like why it's
It
not.
just
Go ahead.
it's this narrative that I think it starts ultimately from Wall Street and the banks, I think. That's my conspiracy theory. But they make, they make investing like it makes it like it's so hard and it's so risky. Like we're talking like we're rebelling against because there's so many terms that if you want to start reading financial statements, if you want to start making actual decisions on which companies to buy to outperform the S&P 500 or the stock market benchmark, there's so many lingos that you have to do. Like you have to like people's full-time jobs, very 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 smart people, their full-time effort in life is to pick, which stocks are better, which strategy is better and whatnot.
Mhm.
And then the narrative always gets passed down to the common average guys that they're like, hey, you can't do it, leave it to a professional, like you don't know what
Mhm.
you're doing, like even if you did it yourself, like you're not going to outperform, blah 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 blah. Like that, I think that all got solved with index funds, like we keep talking about. But even on the individual stocks level, if you do sound like like investment decisions, it'll take a little bit of work, right? Like looking at their financial statements, it's a lot of new lingo, but it's not that hard to learn. Like in a 1 hour
Mhm.
YouTube video, you'll probably learn like all the basics and what to look for, and you don't have to know like, oh, like if EBITDA is this or if the book value of this is that. And you don't need to know all that. It's like if they have a lot of cash to withstand the bad times and they're making a lot of profit and there's a reasonable expectation to grow those profits and cash reserves and the investments that they have, the stock's gonna go up. That it's not that hard. I mean, obviously there's external factors with what the Fed's doing, what that country is doing, what that
Mm.
group and that sector is doing and whatnot. But yeah, like the average person, they can invest and get good returns. That's why it hurts me personally when people are like, oh, like I think I'm gonna get a financial advisor. Like, dude, you really don't need a financial advisor unless you're like really dealing with large sums of large money. And there's so many proven research backed studies that say, if you give your money to, someone else to outperform the S&P 500, majority of the time they can't do it. And I'm talking about majority like 90 something percent of the time.
Mhm.
Not in a 1 year, but like over the long period, like maybe let's say 10, 20 years time period, they can't do it. So how about you just go sit on your couch, download a little app, put some money in it every month, and keep buying index funds? That's the fastest way to make money because it's definitely not.
Yeah.
But it is the fastest way to make
Most
money
sure.
in relative to the risk that you have.
Mhm. Mhm. Yeah. Yeah, dude.
People that care about, they're like, oh, I'm gonna get a finance. Yeah.
Yeah. I think that's like, to put it in different words, that's like the most guaranteed way to make money in the conversation of stocks, right? And then again, just to double down on some of the points you made, like from a financial literacy perspective, right? There's varying levels of things to know about the stock market. Like you got into, I think like option trading and stuff for a while, which I never even touched, and it could be a little bit more nuanced. Or from a time perspective, like again, if you want it to be more passive, like penny stocks and like day trading, things like that, much more time intensive, maybe requires a little more knowledge. Again, you don't have to be into any of that. And I think I have some level of financial literacy, but I just read this book recently. I'm gonna look up on my Goodreads app, Financial Intelligence by Karen Berman, and it was more along the lines of what you also talked about a little bit, like profitability of a company, how to evaluate a company's profitability or enhance the profitability while working for a company, like maybe as a manager or something like this, something like that. Talked a lot about balance sheets, and I was just
Mhm.
like, not only was it I mean, it was interesting to me to an extent, I'll say, to someone who's probably going to shift to corporate America, but it could get dry, and it was like a lot of new words and new, acronyms and just things I had never thought about. And that was me when I was approaching the stock market. I was deterred by all this terminology and these things that I was unfamiliar with. Much like reading this book, how it talked about companies. And I just want to put everybody's mind at ease. Like it doesn't have to be that. You can certainly a big advocate, both of us, of reading. So you can pick up a book that's, basically stock market for dummies. You can watch a quick YouTube video, or you can just get on the app without investing. And this is one thing I would recommend, and just kind of
Mhm.
play around. Like most of the apps will break down those companies, the things that they've done recently, what their projections are, what the company plans to do, and you could do it that way just from within the app, and it'll give you some research right then and there. Another thing that for me was cool about stocks, because although I wasn't really interested in history, or even like I was very bad at staying up with current events. I was terrible. But and almost just and I was like kind of living overseas, so a lot of things that happened in
Mm.
America didn't necessarily pertain to me. But what I was interested in was stocks. So I think it's really cool how current events directly affect like the stock market oftentimes. So by me being interested in stocks, it kind of led me into increasing my knowledge or my awareness on current events. And I was like, dude, this is good. This is just good for my personal life. Like it was helping me be kind of more read in on things of that nature, which I was super appreciative of, which is another way, I guess, to look at it, like the stock market, which I didn't even realize until I was kind of in it, just keeping me up on current times. And again, by me knowing what's happening on current times or current events, knowing how that may shift the stock market. And then again, you can make some predictions there, which goes against the idea of, just kind of getting in and getting in the index fund, or maybe something that's very easy, requires minimal of the investor. But nonetheless, it's another way to one way to just kind of stay savvy on the stock market. That again was a byproduct of me being interested in stocks that I didn't even account for. So I was like, oh man, like this is kind of cool. And then you could play around with like the predictions. Like this just happened. Oh, like let me check this stock like in a week or two. Like let me see how this stock's gonna shift. Oh, okay, it went down. It did because of this. That's what I thought. And then it becomes like, I mean, we've alluded to the stock market before, like almost being a game to us, contrary to it being a gambling platform. But it is cool to kind of see, how your predictions fare based on what's happening, real world. I thought that was kind of cool.
Yeah, I mean, if you're gonna put money into those like prediction plays, I don't. It's like the number one important thing for everyone is to stay invested for the long time, like long term. That's the most important thing. But in order to do that, if some people are like, "Oh, like I have, like I just want to gamble," like that's what you want to do. I would say it's not, as long as you're not gambling with everything you have. I'm okay with it, right? If people are like, "Oh, maybe 90% of my portfolio is in index funds. I never think about it. I never touch it. I put money in it every month." But then the 10% of it, because of these current events or whatnot, like I think these gonna do well. Let me put some money in it. And it's just like a game. Sure, if that makes you stay invested for a long time, I'm totally for it, right? Like at this point, like I don't have I don't have an emotional attachment to stock market anymore, just because my focus is in real estate. But so that makes it easier for me. Like I don't get more, just put money in it without really
Hmm.
thinking about it. But yeah, it's
Yeah.
there's a lot of ways to do it, and there's so many finance gurus that are like, oh, do this, do that. But I take more of a like a middle of the road mindset. Sure, if you want to gamble with a little bit, I think it's fine. But then, just making sure that you stay on track for the main goal that you have.
Yeah. I like how you said that middle of the road mindset, and I think that middle of the road mindset cuts through the volatility of the stock market, which which I think that volatility, Jesus, is often associated with that risk. Like people say it's so risky because the stock market is so volatile. But if you do right, like we talked about, like the dollar cost averaging, and just do a little bit, invest small amounts like over a long period of time, you can almost like negate that volatility, because you're gonna ride out the highs, you're gonna ride out the lows, and although it's up and down, that it's up and down in an upward trend, over the long haul, you're gonna be good. And we're not saying like, yeah, like throw in 90% of your life savings in the stock market and just, take one big risk. No, it's a little bit for a lot of bit of time. And that's how you I think that's how you reap the true benefits. Like the stock market returns like almost 10%, like 7 to 10% annually, adjusting for inflation, like over the stock market has proven to give you returns, if you play it safe or if you invest correctly. Like it's data driven. Yo, Rebby.
I pulled up the actual numbers, right? And this particular one that I pulled up, it says in the last 32 years, the S&P 500 index in US dollars, I don't know why the dollars is there because it's percentage based, it has returned 10.57%. Right, so that's
30 years.
that
Yeah.
particular figure is not accounted. Yeah, it's not accounted. The 10.5 is not accounted for inflation, but let's say it returns 10. We'll be modest here, right? And we'll say 3% for annual inflation, which
Mhm.
is probably going to be start trending towards the 3% rather than the traditional 2% for inflation. We had high inflation numbers recently. Looks like it's coming down, but you invest for, I don't know, the dollar cost averaging thing that you said. Like I agree with you. I wanna talk about that after this. But you put in $500 at pick a day, 1 through 30. You can do it any day you want. And each month you throw in $500, like accounted for inflation. So when you account for inflation, you take the growth rate, of 10% minus the inflation rate of 3%, let's say. So you have a real rate of return at 7%. You put that into a calculator, you're gonna have in what's the number? In 40 years, $1.2 million. And that's in today's
It's dollars.
what you think of $1.2 million today is what you're gonna have in purchasing power in 40 years. So the number is gonna be like, I don't know, $8 million, but you can treat it as 1.2 today. So yeah, I mean, like that's gonna solve a lot of retirement problems for a lot of people because that number is not really calculating the 401k that you put in, the savings that you have, the Roth IRA that you're using, the Social Security that you probably won't get, but you get the idea.
Yeah.
And with the another reveling point on the piece that you talked about was, I don't understand how they say, risk, it's because it's volatile, it's risky. That's not what risk means. Like they have a word for that, which is volatility. Like they have like word for that, but then they correlate that
It's
to risk.
associated with
Two different things.
Exactly.
But like if a stock goes up and down and up and down, up and down, but then if the overall trajectory is guaranteed, let's say there's such thing as like it's guaranteed to go up, but then goes up and down. That is not risky whatsoever by definition. Like it's actually very, very, very safe.
Right.
And then here's another reveling point that I encountered in my personal life with a lot of different people. I was in the Navy. I just got out a couple years ago. Jillian is still in the Navy, and then not even for the military, but government employees. The 401k plan that we had is called Thrift Savings Plan, and you can choose from pretty much 5 funds. And within those 5 funds, they say, hey, this is low risk, this is high risk, and whatnot, right?
Yep.
And it's so funny because it's not true. They say that we have what's a thrift savings plan. Thrift savings plan has a fund called a C fund, and the C fund is they mimic the S&P 500 index. And you can talk to any like knowledgeable financial investing guy or girl, and they'll say S&P 500 is like one of the safest investments you can make, right? But on TSP, for some reason, they classify that as high risk because it's more volatile. And they say low risk, like, and so you look, okay, if that's high risk, then what's low risk? They give you like government bonds. I'm like, government bonds? I think government bonds is like one of the most risky investments you can make. And they were like, but it's gonna return. You'll never lose money. Yeah, that's not the point. It's like You want to invest to not increase the money value. Your money value means nothing as long, like people have a very hard time understanding this idea, but $100 means nothing because you don't know what that $100 is going to buy you in 50 years. Today, you can buy, I don't know, like a week of groceries for $100, let's just say, right? But in 50 years, $100 might not even get you like a pack of gum, right? So that's purchasing power. That's inflation happening in real life. So if government bonds are returning 2% a year and inflation's running at 3%, that is a guaranteed loss.
Yep.
I don't know about you, but like guaranteed loss it seems very, very, very risky to me. It's like the riskiest thing you can invest in. So that idea I never understood the logic behind that. Now, I understand, right? Like, but I'm just poking holes because it's so illogical in the way that they identify risk. And yeah, it's crazy. You tell someone the S&P 500 is the most risky investment out of the 5, like people laugh at you in the real world.
Yeah. Ooh, that might be a conspiracy. Like, why do you think they proposed that? Could it be they want to like minimize your profitability, or not even profitability, but like, yeah, your earning potential in those funds? It's like, dude, it's just a rabbit hole. Like, yeah, why do they default, the most of that fund to the G fund, which, I mean, we don't even have to go down the hole, but it's certainly interesting to dissect. And again, as a member, right, you can go in and then just adjust where your money's allocated. We've had plenty of personal conversations between us like on that, but yeah, dude, I agree with you, and it kind of raises your ears like, wonder what's the logic here. But something I think we might have alluded to, but I don't think we've like touched on directly, is also within stocks is like the compound growth, right? So you could, if your stocks is returning, or let's say, I think the most common example is dividends. Like if you have a dividend stock, which not all stocks return dividend, but quarterly, or I don't know, annually, if a stock says, hey, by holding shares in this company or this fund, whatever, you get, this dividend, this X amount of money. And then now as the investor, you can choose what you can hold that dividend, you can withdraw it, you can reinvest it. Hey, everybody, thank you again for listening. We do not take it for granted. For the next 3 episodes, we're doing something special. If you've made it to this point, please, 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 if you're willing, leave a review and screenshot it and send it to our email, which is rebelwisdompodcast@gmail.com. And we're gonna be sending out some gift cards. So we'll be sending a $20 gift card for all that. For the first person that made it to this point, leaves a review, screenshots, and send it to the email, which again is rebelwisdompodcast@gmail.com. We always appreciate your efforts, so stay tuned. But for the sake of compound growth again, and for a mindset of it being passive, if you just opt to have that dividend just like reinvested, now your money that you're making by holding that stock and getting that dividend, that money is just continually making money for you too. So those are other little things that the stock market can afford you to just continually grow what's already in there, and pretty effortlessly as well, which I think I'm always of a fan of minimal effort, especially when it comes to making money. Minimal effort, make more money. Hey, sign me up. Where do I sign? So I think that's always something to think about, or just the money that your stock's making. Like it'll that compound growth is a beautiful thing in the world of stocks.
It's funny because for the compound growth piece, Albert Einstein, a genius figure that humanity has ever seen, right? He says the 8th wonder of the world is compound interest. And obviously, like mathematically speaking, he understands compound interest. It's not that hard to grasp. But then when you throw actual numbers into it, you're like, holy crap, this is kind of insane. Right? Because let's say you get to $1 million one day, and if you invest in it, you will get to $1 million one day. I guarantee it. And you return 10%. Like you're now on top of the money that you're putting in, the stock market is giving you back $100K on your investment.
Right.
And now the next year, and then you get to 2 million down the road, and then it's still returning 10%. But then that amount is now $200K.
Right.
You know, it's insane. Like you look at the little graph and it starts so slow,
And then
and you look at a lot of YouTube videos. A lot of YouTube videos, they're like, "Oh, just get to that first 100K because after that, compound growth does so much for you for your, I guess, whatever you want to use stocks for, a retirement, buying a house, rainy day fund, whatever it is."
yeah, yeah. And this is not us telling you to like get into stocks but it's just like, I don't know. It like makes sense, especially more so just to invest. And we're just highlighting, you know, the perks of maybe utilizing the stock market and also why it goes against this original narrative of can't make money and why it's so risky that it creates a psychological effect that, it almost scares you away. And I think it's interesting too, and that slow like growth you're talking about, that is the timepiece. Like that's combated by time. You staying in for a long period of time, like hold in that slow phase, and you will see the growth, the compound growth. It will happen over time. But I thought it was interesting going back to the structure of the thrift savings plan, which the military affords. And you saying that like, the G fund, if it gets 2%, it's not even beating inflation, which might be 3%. It's interesting. There's a similar effect on like just everyday life, just getting in the stock market in general. Like inflation, and inflation might erode the dollar or its value over time. But again, getting into the stock market is a way you can kind of counteract that inflation, I think. So just different ways to think about why to get in the stock market, like conceptually, or yeah, really just why to get in. I mean, we talked about when to get in it. If you have the money, it may be a viable option. But then again, just exploring all the reasons like why you should get in and why it will either like mathematically or statistically, logically, whatever, all of the above, kind of help you as just an individual in the long run. And to your last point, why you get in can be different. If you're trying to build up money for a specific purchase, if you're trying to build generational wealth, it doesn't matter. All we want to highlight is that hey, it can enhance your life. We're here for the people. Like we love to talk about why things can enhance your life and why the narrative is preventing people from taking advantage of these things that can help your life. That's all. We're here for the team. Definitely team effort over here. So I don't know. I kind of said a lot of different things, but like,
Okay, if people wanna, I mean, getting money is hard work, and the money that you get through hard work, you want it to just, drain it down the toilet. Don't invest. You don't have to invest, right? But it doesn't make sense.
yeah,
And there's always like, I think I get the true idea of what people think about because I spend a lot of time on Reddit, as mentioned previously. You know, you get so many crazy different takes on Reddit, but then there's so many within those takes. A lot of people are like, if he said this, if he summarized this podcast, like into a Reddit post, and they say, hey, invest $500 into index funds, blah 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 a month, and there will be so many people like, oh, like I don't have $500 a month. Okay, go get $500 a month. Like it's not that hard to get $500 a month. Like, oh, dude, go get a second job. I don't know. Go drive Uber. Go do Instacart. Go start a side hustle. Go sign up on Fiverr. Go like. There's so many ways to get it, and it it's honestly the only thing you're holding back from investing $500 a month is you. That's it. I don't know. I actually don't know anyone that's age of that's out of high school that physically cannot get $500 more, and they choose not to. That's a choice not to get the $500, if that makes sense.
yeah. Secondarily, like to add on to that, if you can't, and I'm sure there's wild circumstances out there, right? I try to avoid like talking to people's circumstance, got it. But like, if it's not $500, like it could be something. Like just do something, and you can work your way up to $500. If you can start with $200, and then you maybe after a year 400, double it next year 600. I don't know. There may be a different plan for you, but you starting, I think beyond the dollar value is just doing something. And that's what like when I was talking to my mom, who again, and this is why it's different for different people because she's way older than me. She's in her 60s, right? So she doesn't have that time aspect to play with. And she literally put in 100, but that was like, very entry level, just trying to kind of see. But it fostered interest. She was able to see the market, how the money reacts, or just learn about, different companies, etc. But it's a start. It's something, and that's would be one of my biggest takeaways is that, do something before anything else. Yeah. The hardest part is usually starting.
Yeah, and the starting is like hard. Man, starting is hard, or not in the sense that like, yes, you can download an app, you can put some money.
Yeah.
It's very
Right.
probably take 5 minutes to download something and put money in it and buy something, right? But being able to, take advice from the right people, I think that's the hard part as a beginner, if that makes sense. Because you can foster interest in the stock market in so many ways, and a lot of them are bad. Or I don't want to say bad, but inherently risky. I keep going back to Reddit because it covers everything. But go do Wall Street bets, right? Like like a lot of people make a lot of money, like basically gambling in the stock market. But even though it's a lot of money or it's a lot of people, you look at the percentage based of those people, you're talking about like the 1% that actually make money. The rest of the 99%, they're it's very close to like buying a lottery ticket. You put $10,000 into this very risky thing, and honestly, like 80, 90, 95% of the time, it's gonna go to zero or close to zero. But you see those pictures and the posts of those very few people that are making millions of like a $10,000 investment, and then you're like, oh my God, like what about me? They don't think about the actual math behind it. They look at the dream. They're like, oh, I can spend 10,000 and what if I got millions? Like, what can I do with my life? I can buy a house, I can retire my family. And you're I mean, you do it over, maybe you might get lucky the first couple times, let's just say. But then because you're risking it all, if it doesn't work out on the eighth time, like you're losing everything. Right. And I mean, I don't know, you just kind of screwed yourself of like, let's say like 30 years of investing. If you got some early wins and didn't take profit and walk away into a sound investment strategy and you kept going with like this gambling mindset of, Wall Street bets. That's just one example, but there's a lot of different groups that talk about stuff like that. And then you also mentioned about the penny stocks. And penny stocks, I definitely hear more on the daily basis because I have family members that would be like, "Hey, what do you think about this stock?" And I'll look into it. I'm like, "All right, let me look at the financials. Let me look at the market. Blah blah blah." And first thing I pull up, it's a penny stock. I'm like, "All right, I don't think you should invest in it. I didn't really do any research, but I don't think you should invest." They're like, "Oh, but they have the only right in the entire world to do this. Blah 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 blah." It's like that logic doesn't apply because if they truly had that, they wouldn't be a penny stock, right?
Mm-hmm.
Like they would be actually making money. And so the fact that, like, I'm not saying all penny stocks are bad. Obviously, people make money in penny stocks. That's why it exists. But like I said, overwhelming majority of the people will not make money in that. So it just doesn't make sense. Do it with the 10% that I was talking about. If you want to gamble a little bit, you can do it. It's for fun. It's not for real life, if that makes sense.
Yeah, and then off that fun, like you have the potential. Like if you do get a lot of money, like it is real life. It's like it's good when it's good, but then when it's bad, you're only losing the 10%. And going like to the penny stocks, and examples and stuff that you gave, that is, we've been talking a lot about how like it's not risky, it's low risk, like you minimize risk. But don't be mistaken, there can be risk. Like that's why there's different avenues and methods, different things to invest in. Those are the cases where high risk, like high reward, sure, but high risk. And again, it's just statistically, you will lose your money. So if you have the opportunity or the willingness, it's all about what your risk tolerance is. You have high risk tolerance, or maybe you're in a position where you can and are comfortable with losing a lot of money, sure. But again, you're putting in a lot of money and trying to make a lot of money in a little bit of time, and that statistically is not a winning method. We want everybody to thrive, and again, just trying to give our background. We're not financial experts. We definitely don't know everything. Between the two of us, B is definitely our resident financial wizard between the two of us. But like, sure, our knowledge is limited too, but we can speak to what worked for us and what we've read about and what, again, on average, because that's what we like to default to, what works. And that is the long plays, the index funds, the ETFs, where things is bundled. You're diversifying, which allows you to minimize your risk. You holding through long terms allows you to keep that middle of the road mindset, the term that you use, to play through the volatility, which isn't synonymous with risk, although culturally it is. Those are the things we're talking about, right? Yeah.
You don't even listen to me. Like
Yeah,
I would be the
go
last
in.
person that people should be listening to. Like listen to the goats. Listen to Warren Buffett. Listen to Peter Lynch, and listen to Charlie Munger. They don't, they are stock pickers. But then when they give advice for the average person, because the average person is not a stock picker or not a good one, they say just buy index funds. Like that should speak. I mean, that should be the only people you should listen to, honestly. And then one thing now we're talking about Warren Buffett and books kind of reminded me another rebelling point is I go to it's for the average beginner investors. You should read books like Julian said, and there's a lot of good books, but then the most common you go do a Google search on what investment books should I read, and a lot of articles, a lot of people swear by the idea that you should read the book Intelligent Investor by oh my god, I can't believe I'm forgetting his name. Graham who is it?
You said Graham. I know you're talking. I'm blinking too. That's a quick.
Benjamin Graham.
Benjamin Graham.
I can't believe I forgot his name, but he's regarded as the person that taught Warren Buffett, which he ended up being the greatest investor of all time, besides people in government that does insider trading. A lot of people are like, hey, go read this book, blah, 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 blah. And I did as a beginner investor. And I would say, like, dude, please don't read that book because it is one of the most boring books that I have ever read in my life. I did finish it, but it was so boring. A lot of the stuff that he teaches is good, but it doesn't take 30 hours of reading to understand the concept. And then I'm not saying it's a bad book by any regard, but what the point that I'm trying to make is for the beginner investor, there's so many other books that are better for you and easy to understand. And the one thing that I don't want for people is to have interest in investing. They go pick up that book and they lose interest in investing because it's such a hard book to understand. It's a lengthy book to read. And yeah, like going back to the goal of you should have time in the market. Like I don't want them to be swayed because of this book. And I have to point this out because there's overwhelming articles, people talking about, hey, you should read this. My take, and as a rebel, like I say, hey, please don't even bother, don't even look. Maybe 5 years into your investing, you can kind of read it just to say that you read it, but I had to throw it in somewhere.
Okay, that's good. I have not read that one either. On the topic of literature, what I know you've read it. I'm pretty sure you read it. It might be a while, so if you can't answer it, don't feel obligated. But what do you think about the Little Common Sense Book of Investing by John C. Bogle? Because it
I think
implies in
there
the title,
is
right? It's
better.
like the common sense, like it's a foundational book. But I don't know. I had some very opinions on kind of like you said, like maybe a good book, but I mean this one it definitely has some like foundational stuff. But I don't know. I just kind of want to get your thoughts on it. It's probably a while since you read it.
Yeah, John Vogel. I mean, like he's another one of those greats, right? He's one of the goats. I don't know if I think he started Vanguard. I think no, yeah. He didn't start it. Like he was but then he created the first index fund, and so like the VOO type. He created that, and then every company has it now. But I think there are better books that talk about his ideas. but it's one of those books that's like it's a classic. It's like it introduced the idea very early on, and obviously as people learn about it more, there's gonna be better books out there for
Mhm.
to learn about that idea. But yeah, I mean, like as a concept wise, like to something to get started, I think it's a pretty good book because it's pretty short. But if you're like a seasoned investor, like you're not gonna learn much, to be honest. But for the person that's trying to pick it up and go in the right direction, I think that's a good like a guidepost to
Yeah.
stand by.
You talking about the intelligent investor made me think about, may kind of remind me of that. I have some similar I mean, this one might be a little bit better for a novice investor than what you were talking about, but it became like repetitive to me. Like I said, I do remember having like some good foundation principles,
Oh
and it wasn't
yeah,
too long. So I mean, I guess I would recommend it, but a little bit dry. Yeah, that's it. I just kind of want
yeah.
to get your 2 cents on that. Okay,
I
you
think
got
yeah,
some
I
good.
think the better book that covers everything, yeah, like better books that cover everything is, I mean, my number one's gonna be Psychology of Money, not Rich Dad Poor Dad, because that's not
It's not
necessarily
an
a
investing book.
stocks book, but yeah, or yeah, more on the yeah, like money mindset is like
Money
Rich Dad
mindset.
Poor Dad. But yeah, but Psychology of Money, Morgan Housel, like he, dude, I mean, and he writes good. That's another thing. Like, the books like in like 1980s and before,
Good.
it's just so bland. It's like you just read it. It's so there's no creative writing aspect to it. And then somewhere, yeah, it's like reading a textbook.
Dude.
And then, like, and then better writers come in the market, and obviously to write a better book to make more money, to help more people, you have to have those creative, interesting,
Mhm.
you want to be sucked into the book. And then Psychology of Money, at least they did that it did that for me. It's not a long book. It's broken into 20 chapters, 20 ideas, so you can consume it one idea a week or something like that, and very manageable. What about you? You have a personal favorite?
I love it. For stock specifically, um, no, I'm looking through my like maybe money book. I don't have one on stocks, dude. The best one I could recommend again for this conversation might be the Common Sense Book of Investing, but that's only because I haven't read a
Mhm.
lot on stocks particularly, not because like that's the best one
It is a
now.
good start. It's a good
Yeah,
start.
yeah, yeah. That would be my one for starting. I have other ones for finances. Shout out to you. One of my favorites is probably like Pillars of Wealth, David
Oh, yeah, that's
Graeber.
a good one.
Yeah, but again, not necessarily investing. Probably talks about it a little bit, but breaks down like what he calls like 3 categories of how to handle money. But yeah, for stocks, I don't have one. I was just about to say though, I love
It,
we used to get into a lot like book recommendations in our in some of our episodes. So it felt good to kind of I think we threw out about like 4 or 5 books throughout the duration of this conversation, which kind of came up pretty naturally, which is awesome. If any listeners have any book recommendations that we didn't throw out that you think we would benefit from personally, or that you think a like novice audience would benefit from on this topic, please like
mhm.
throw them in the comments. Those are always welcome and encouraged, and like we're always looking for new stuff to read as well. So take full advantage of that. Are you about to say something else, B? Yeah. So like again, we're all for promoting the rise of all financially. Again, with literature, we'll take any recommendations there. But yeah, the stock market can 100% be a tool if used correctly. Don't that last piece is crucial though. It is not all risk. It is not a gambling platform, although it can. Well, a lot of people look at it like that or treat it as such, but it's not. So yeah, hopefully this sparked some decent conversation, or maybe it did what it did for me years ago between me and B, and it just kind of started tickling your brain and gave that introductory interest. And like, okay, let me download the app and just play with the app. You don't have to when you download these apps, they don't force you to put money into it. Again, I only have two. Can't speak for all of them. I'm pretty confident. Like there's no requirement to put money in to download the app and like browse
A
around the
good,
app.
yeah.
Yeah, see what a ticker symbol is. The 3 or 4 little symbols that identify stocks. See what these companies at face value, what they're about. I mean, sure, you can go on Google and do the same thing, but that could be a starting point. And that's all we're saying is get started so you can get some coins in your pocket.
As it, and one thing I do want to say, you brought it up in the generational wealth episode, those couple back. Like hopefully, like what we're trying to get at is, you know, believe in the idea that you can make money. And I think that's the big barrier to a lot of people, because they think the stock market is for the, old rich white folks that can, make money because they got money. That's it's just not true. You gotta believe in that you can make money, and education will kind of boost your confidence. But yeah, just making or breaking that mental barrier, that's like the first step.
And you mentioned money mindset, which that is kind of a piece of the money mindset, and believing that you can do it no matter what ethnicity demographic you come from. Because thinking you can't, that's a lot of times what perpetuates this wealth gap, which we have an episode on. So go check out the wealth gap episode if you haven't. But that's what creates this divide and will likely keep you where you are in whatever financial position you are, but it will keep you stagnant. And that's all we want. We want to see our people win. So, thank you for listening. Hope you found value. That's always our goal in these conversations. One, we kind of just like to talk to each other about these topics, but within that, we hope you find value. So hopefully we'll have the privilege of catching you next week and hope you enjoy it. Thanks for tuning in.